Welcome to Melbourne, to La Trobe University. We're delighted to have Professor Eric Leeper from Indiana University. Let me also welcome my colleagues and some students. We're here today to talk about the monetary-fiscal interactions. And the obvious question is, what interactions are we talking about? I mean, given that most countries have an independent central bank, is there any interaction at all between monetary and fiscal policy? Can you just outline briefly what the interaction is about?
Well, there are always interactions between monetary and fiscal policy. Essentially, monetary and fiscal authorities have two tasks to accomplish. One is they have to target inflation, and the second is they have to stabilize debt. And there are different ways in which these two tasks can be accomplished. So you alluded to central banks targeting inflation, and that's one way that those tasks can be accomplished. But then the fiscal authority has to be assured that eventually, anytime there's an increase in debt today, taxes or spending will adjust in the future. But that's only one way that those two tasks can be accomplished.
What's the other way?
The second way, so I refer to the first one as the standard, I call it regime M. The second way is regime F, M for monetary, right. The second one is regime F for fiscal. And in this environment, you have that the fiscal authority actually controls inflation, and the monetary authority ensures that government debt is stable. And so these two ways of interacting will accomplish those two tasks that at a basic level monetary and fiscal policy have to accomplish.
Now, I think this second channel is a bit of it's a bit controversial amongst economists, and I'm sure we're going to get to the details of it a bit later. But I've got a slide that portrays the former Prime Minister in Australia, John Howard, and I think this is a situation most of you are familiar with. This is from the 2004 federal election campaign, where one of the parties, the Liberal Party, came along and said, look, you see, under Labour, interest rates have always been higher. This is the red region. And you see, under the Liberal Party, interest rates have always been lower. And this claim very much goes to the heart of monetary fiscal interactions, right? Because the claim is that the fiscal authority will actually have an effect on interest rates and inflation. So what would be the most natural channel? If the government's running a deficit, how does it affect interest rates and inflation? What's the the first year macro type of story?
Well, the first year macro story, which is actually hard to detect in data, is that the government borrows from the private sector, and that increases the demand for loans, and that would tend to drive up interest rates. But that's a story that says that the central bank is focused singularly on keeping inflation under control. So that would be the standard story. That would be the regime M that I was referring to. But there is this other regime also, regime F, where these fiscal deficits increase the wealth of the private sector, and when the private sector is wealthier, it goes out and tries to buy more goods and services, and by doing that it drives up the inflation rate.
And the private sector feels wealthier because there's no offsetting in the expectations that taxes will rise in the future to cover the debt that's being accumulated.
Yeah, precisely. So for example, if you get a tax cut today in this regime F world, there's no expectation that taxes will go up in the future or that spending will be lower in the future, and so you feel better off, and you try to convert that into consumption goods.
Interesting.
So it increases aggregate demand.
Now, I would like to, we really need to give a bit of a background about fiscal policy, because that's what seems to be driving, that's an interesting kind of development in the monetary fiscal interactions. And most of the current media attention is on the short-term issues. So to kick off the discussion, let's look at this slide, and this is from one of your papers using Congressional Budget Office. Can you tell us a little bit of the background of what we see here?
Well, what the Congressional Budget Office does in the United States is it does these long-term projections. And what's labeled the baseline scenario there assumes that current policies will remain in place forever. By current policies, I mean current tax and spending policies. And then to produce this picture, it says, okay, given all the spending obligations of the government, if we just roll those over into debt, so we finance them by borrowing, then you get these two lower pictures.
So let me, maybe you can't see it clearly. This is, the lines show you the public debt as a percentage of GDP. And what you see, and for the United States, and what you see traditionally, that was around the 50% or below the 50% debt to GDP ratio, with the exception of the Second World War. But what you see is that even the baseline, a relatively optimistic scenario, would lead to some serious debt problems in the future. What about the alternative scenario?
Okay, so the alternative scenario is one in which the CBO builds in the adjustments in policies that they think are most likely to occur. So under those assumptions, you can see that debt just explodes. So the interesting thing about this picture is the baseline scenario is one in which nobody believes, one that nobody believes can happen, or would happen, I mean, because policies would change. But the alternative scenario with the exploding debt is one that from an economic standpoint can't happen. It's impossible for debt to grow as depicted in those blue lines.
When, I mean, at what percentage of debt to GDP ratio do countries start to run into debt problems?
Varies a lot from country to country. In the 1990s, Sweden ran into problems at levels of 70% debt GDP. Belgium, on the other hand, was running over 100% debt GDP and didn't seem to run into any problems at all. Japan now is approaching 200% debt GDP, and while they've been downgraded, there's no obvious premium on the interest rates that they have to pay. So it very much is a country-specific issue.
Now, in relation to this picture, the most of the media attention is on the debt ceiling in the United States. Now, we'll talk a lot about the fact that the biggest problem is actually looming on the horizon. But can you give us a brief summary of what's happening now and how you think the situation is going to be resolved, or whether what kind of, if it's not being resolved, what your research predicts could actually start happening at the end of July, when financial markets realize that, in fact, maybe there will not be an agreement reached?
Well, I think the answer to the question of what's going on now is really a political answer. I think the short-run fiscal problems, and especially in the U.S., this debt ceiling issue, is just a red herring. Because politicians don't want to talk about the big problem, which is what we see in the out years, but they want to look like they're doing something. And so you have the political parties positioning and saying, you know, we want this kind of adjustment versus that kind of adjustment, and it makes the voters look, it appears to the voters as if they're actually doing something. But I think it's really a non-issue. What economic theory would suggest is, as we get closer and closer to that D-Day, which
August 2nd, I think.
Yeah, I've heard different estimates. July 22nd was another D-Day, so who knows? I think financial markets will start to get increasingly nervous because it's unclear that the U.S. will be able to honor its debt obligations, and this would be absolutely unprecedented. And you might start to see interest rates in the U.S. and therefore in the rest of the world start to run up. So that's what theory would say.
And what would rating companies, I mean, would they wait for something to happen, or already in late July they might do something which will further kind of trigger the problem, or further make it worse?
Well, they're making a lot of noise already, right? I think the U.S. is on negative watch or something now. It wouldn't surprise me if it got downgraded. That's a funny game that gets played, though, so I don't know that I read too much into what the bond rating agencies say.
Now, continuing on to the next slide, let's talk about some long-run driving forces behind what we've just seen behind the debt problems. What you see here is the old age dependency ratio, which is defined as the proportion of population aged 65 plus over the population between 14 and 64. And this is G7, and we also plotted China and Australia for comparison. And what you see is that countries are growing older. Now, why is it?
Why is it that they're growing older?
What are the main driving forces?
Well, after World War II, there was a baby boom in most of these countries. And so fertility rates were extremely high relative to what they've been since then. And now this baby boom is starting to retire. And the fiscal problem here is that most of these pension plans are not funded. So they are sort of pay as you go. And that means that they rely on there being a lot of workers for every retiree. But as the populations age, you get fewer and fewer workers per retiree, and therefore the revenues that you were getting from those workers are shrinking, and that's why we have these big problems.
But it's also healthcare, right? I mean, health costs increase almost exponentially once
Yes.
Once the age of about 65 is reached. So that's another.
And health insurance, health costs have been growing much more rapidly than overall inflation in most countries. And then on top of that, the vast majority of expenditures occur in the last year of life. And so as we get more and more people who are reaching their last years of life, those health expenditures rise dramatically.
Let's move on to the next slide to see a slightly different perspective. This is the total dependency ratio. It's the kids plus the old over the bulk of the population between 14 and 64. And what you see is that we've really, in the early 2000s, we've really been in the situation where in fact, somehow most favorable. And the chairman, Ben Bernanke, talked about the global saving glut. And we do see that, you know, if you have a lot of people working and not that many old, not that many young, then it creates maybe excess of savings. And the interesting implication is that as we move into the future, that situation is going to be quite dramatically reversed. So we might discuss some of the implications for the capital and labor markets a little bit later. Now, can we have the next slide? It actually shows that the situation is even worse than what the pictures show. So this is pensioner per worker ratio. So this is the dark shaded area, and the light shaded area is what we just saw previously. It's the old age dependency ratio. And you see, for most countries, the pensioner per worker ratio is 50 to 100% higher than the old age dependency ratio. Why? Because many people below 65 are obviously not working, and there's a few other reasons. So the situation seems quite. Now the next slide is going to show us, break it down for advanced countries as well as developing countries. So if the whole world is aging, or can we think through the implications for capital markets? I mean, if all the retirees are now looking to use all their savings, but there's actually no one on the other side who would provide, who would be willing to save and provide that, what's the implication for capital markets? I mean,
well,
are we going to
interest rates will rise. I mean, it's fairly straightforward. I mean, and I think the U.S. is a bit of a microcosm here, because we've been relying very heavily on the savings rates in China, Japan, the Middle East, in order to finance our lavish government policies, and we won't be able to rely on that.
So that situation is going to change now. Now, in terms of the unfunded liabilities, it seems to me, and correct me if I'm wrong, but it seems to me almost like a bit of a Ponzi scheme that the government is running. I mean, you know, it's promising, it's making all these promises, but these are unfunded. Unfunded. I mean, the money is just not there in the pipeline to cover all those promises. So where's the political economy imperfection? How is this possible? How come? Maybe we're moving from economics to politics, but this is what one of my colleagues, Don Harding, he's not here unfortunately. He's kind of pushing me. What's the imperfection here? Do we have some kind of myopic voters, or do we have some kind of problem with democracy where people just don't internalize these kind of trends and they don't vote for policies that are going to fix the problem? Well, how come it's not happening in most countries?
Well, the first thing I want to say about unfunded liabilities is to just be clear that it's an odd term, because in terms of economics, they can't exist. So you have to ask yourself, are they unfunded? Are they liabilities? So the are they unfunded question is, well, yeah, the government's really going to honor these obligations, but they will be funded eventually, presumably through higher taxes of some form. But the other side of the coin is, well, are they really liabilities? And what we're seeing in lots of countries is that, well, they really weren't liabilities. We're getting massive entitlements reform, and the government is reneging on these promises.
That's not a good thing, is it? I mean, if you
not if you're one of the recipients.
If you worked all your life and you've been promised your pension, and then the government tells you. And the reason I'm asking is, many countries, it seems, some governments brave enough to propose a reform, they try to push in the direction of individual savings account. And in Australia, the superannuation scheme, it's worked very, very well to take the pressure of the public pension system. But in many countries, the concern is that something, if they're private companies, they're going to do something problematic with the money. And it seems to me that there's actually much higher probability that it's the state pension that's been promised to the people that is going to go, rather than the money that is saved in a private superannuation fund. What's your
setting aside issues of fraud and so forth? Yeah, I think that's probably right. It's interesting because, again, economic theory makes you wonder, well, why does the government have to do the saving for people? And maybe it is that they're myopic. I don't have the ultimate answer to that. I mean, there was a reason in the United States why Social Security was created in the first place. It was because people were not saving for themselves. And in all these countries, you see that some form of forced savings has been implemented. And I guess even if I can't explain the political economy dynamics of why that's happening, I don't think that it would be a reasonable conclusion to say that, well, all these governments are wrong and it's wrong to force people to save. I think there's a reason that they're doing it. And so I think there probably is a market failure of some form, and the governments have stepped in. Now, a lot of people react to this by saying, well, the whole problem is that the government has stepped in, and so people don't have to take care of themselves.
Problem, right?
Yeah, so you've got the moral hazard problem. And I think that's a bit of a cop-out, because it doesn't grapple with the reality of the history of it. That there was a reason Social Security was implemented. We had the Great Depression, and there were people who were starving. Now, is that because they were expecting that the government would create Social Security? Or is it some other kind of market failure that maybe we can't quite put our fingers on?
Now, before we move on to the implications of these fiscal trends for monetary policy, which is really your specialty area as well as mine, I'd like to ask you, okay, so given the problem, when should we start dealing with it? I mean, should we have these dramatic fiscal consolidations that we're seeing in Europe, in the United States now, or should we wait for the downturn to be over and for the recovery to be in full strength, so that we start? Ben Bernanke again seems to be leaning towards the latter option. What's your view on this?
Well, I think probably the best time to deal with this was 20 years ago. But since we haven't quite managed that, it's hard to turn back the clock. I think it would be a pretty serious mistake to do major fiscal consolidation now. Across the world, at least among advanced economies, maybe setting aside Germany and Australia, the economic recovery has been extremely weak. And a massive fiscal consolidation across all these countries would exacerbate all the problems that we now have. I mean, we're seeing in the UK that where they've had a substantial fiscal austerity plan implemented, that economic conditions there have been deteriorating pretty steadily. In terms of the literature on this, I think that the literature, this falls under the heading of whether fiscal consolidations can be expansionary.
It's the Alesina.
Yeah, I think that literature is seriously problematic. It relies on looking at a handful of case studies, pointing to some sort of general trends in data, and then telling a story. It does not seem to hold up to theoretical scrutiny. It's actually, in the work that I've done, it's extremely hard in sort of standard macro models to generate a short-run expansion from a fiscal consolidation. And the conditions under which that can happen are certainly not being satisfied in these countries.
Well, I suppose you would have to have some very strong expectational type of effects. And this is, I mean, again, some people saying that these contractions would be expansionary because the reason we have a very weak recovery is precisely these fiscal problems that we're seeing. And if the governments are seen to be doing something about them, it actually removes the problem for the skepticism and starts the recovery. But again, that's usually not captured in the mainstream macro models. So.
That was our premise in an earlier paper. This is with Campbell Leith and Huixin B, where what we thought was that if you have a model where, as you start to get close to what we call the fiscal limit, where taxes and spending don't adjust, risk premia start to rise, that then a dramatic fiscal consolidation by bringing those risk premia down could generate an expansion in economic activity. Turns out that doesn't happen. Those effects aren't big enough to compensate for the natural contractionary effects of higher taxes and lower government spending. So while that is the story that gets told, and I think in some countries, like Greece, for example, where you are clearly at the fiscal limit now, consolidation is the only thing they can do. But in the case of the UK, they were nowhere near their fiscal limit. And the idea that a dramatic fiscal consolidation will expand economic activity in the UK, I think is ludicrous. And we're seeing that, in fact, that's not happening.
Now, so moving onto the effect of these fiscal projections on monetary policy, can you expand a little bit on the regime M and regime F, and tell us a little bit about the fiscal theory of the price level, which you invented a couple of decades ago, and this slide's going to go a little bit later, which is related to this is your estimated policy regimes in the United States. So can you give us a little bit more on the fiscal theory, the price level, and the channels that these two policies affect each other? And
okay, I'll try that. So I'll go back to regime M because that's the one that we're most familiar with. So regime M is one in which the central bank is given the job of controlling inflation. And so, you know, that would be an inflation targeting monetary policy. Regime F then is, fiscal authority under regime M is given the task of making sure that government debt doesn't grow too rapidly. Now, the critical thing about regime M for fiscal policy is anything that happens to the economy that raises say the debt GDP ratio has to create certainty that taxes will rise or spending will get cut in the future.
so that's the Ricardian type of...
So this is a Ricardian world, and I emphasize this point about certainty because in most countries we don't have the fiscal institutions that deliver that certainty. And in fact, we're seeing in the US right now that that there's not much certainty that these adjustments will occur. I want to emphasize this point because if fiscal policy doesn't behave in that fashion, then monetary policy can no longer control inflation. And you end up looking like a regime F world where fiscal policy starts to feed into inflation and Ricardian equivalence breaks down.
Now, there's many people who would say, oh, I'm not sure about the story because what we see is that central banks have been very good at controlling inflation and despite these fiscal projections. So what would be your response to those people? How would you convince them that we might actually not be in regime M, but rather than that might be in regime F?
Well, I think I would probably argue a couple of things. First of all, in regime F, what the central bank is doing is it's stabilizing debt. Now, how does it do that? Well, it doesn't do it by raising taxes and cutting spending. It does it by keeping interest rates on debt from growing too rapidly. And that then prevents debt service from exploding. Well, if we look at what central banks in most of the advanced economies have been doing in the past 3 years, they've been keeping the interest rate essentially fixed. In the US, it's zero. And in that environment, what is happening is anytime inflation goes up, you actually get that real interest rates fall because the nominal interest rate's being held fixed. And that means that real debt service is falling. And so the debt stock can be growing, but if debt service is falling, then total debt will end up being stable. Now, so one reaction to your comment is, well, if we just look at history, there are lots of cases where central banks, at least temporarily, focus on something other than inflation. The last 3 years have been a great example. We've had a financial crisis. Central banks pumped a lot of liquidity into the economy. We had the biggest recession since the Great Depression. Central banks have been trying to stimulate the economy by keeping interest rates low. But this isn't the only instance. There are lots of times when financial crises come along and central banks do something other than target inflation. So even if right now we're in a world where it looks like regime M is going on, people know that, well, in the past, we haven't always been in regime M. That means that they put probability on us going somewhere else in the future. This is where expectations start to play the role.
And this is what's shown
and this
here.
is what this picture is about.
The white color is regime F. Is that correct?
Yeah.
And there have been a number of regime switches. We may not go into the detail of what active and passive policies actually mean.
That would be wise.
But in terms of regime M, so that's active monetary, passive fiscal. That's the black policy. So this is the Clinton era, and then also the kind of Volcker disinflation.
Right.
And so your estimates show that into the foreseeable future, we seem to be stuck in this regime F.
I wouldn't say that.
Unless something changes.
Yeah, so this is a world. This is a world where you're never in one regime forever. And so even if you're now in regime F, there's some probability that in the future you'll go back to regime M. Or if you're in regime M now, there's some probability you'll go to regime F.
But I mean, the probability is estimated in your paper from past data, and people could argue is that we live in a different world now. So
That's
the probabilities might be different from what they were in the past, where we haven't seen a default. Now a sovereign default is certainly has a non-negligible probability.
Yeah, and you just put your finger on, I think, one of the key problems that macroeconomists face right now. To what extent can we extrapolate from the past when going into this era of fiscal stress, which, with all due respect to Rogoff and Reinhardt, I think is very much unlike what we've had to experience in the past. And I think, the standard economic analyses come up a bit short here because they don't build in the political economy dynamics that are surely going to be driving policies in the future.
Now this, the fiscal theory, the price level story sounds a little bit like at least to a casual observer, as the unpleasant monetarist arithmetic by Sargent and Wallace. And I mean, both stories basically say, if you have a fiscal problem and the budget constraint is not satisfied through fiscal means, then it has to be satisfied through monetary means. Now, obviously, there is a difference. Can you outline the difference from the unpleasant monetarist arithmetic?
Yeah, the key difference is that unpleasant monetarist arithmetic posits that government debt is perfectly indexed to inflation.
So it's real.
And what
debt,
that
yeah.
means is that when the government sells a unit of debt, it's a claim to goods in the future. And so this is called real debt. And what that means is that anytime government debt goes up, say by a unit, the expected present value of surpluses plus seigniorage has to go up by 1 unit. Now, if you're in a world where fiscal policy is essentially frozen, and so surpluses are just unresponsive to the state of government debt, then the only thing that can happen is the government will print more money. And this is a story about hyperinflations, the Weimar Republic, in the early years, various Latin American countries, and so forth. The fiscal theory, in contrast, recognizes that in advanced economies, the vast majority of government debt is nominal. What does that mean?
It's like 90% in the United States?
In the US, it's 90%. Even in the UK, which has probably the deepest indexed bond market, it's on the order of 80 to 85%. In most other countries, it's 100%. And so what that means is that when the government sells a unit of debt, all that is a promise of $1 in the future. Now, there are lots of ways you can generate $1 without actually printing up money. And so the key point there is that changes in the price level or changes in the inflation rate cause the market value of nominal debt to change. Whereas changes in the price level have no effect on the market value of real debt. And that's the key difference between unpleasant arithmetic and the fiscal theory.
So I mean, the fiscal theory basically can nest the unpleasant arithmetic because the seigniorage is still a possibility there,
right.
But because it's nominal, there's an extra channel in
Exactly,
some sense, yeah.
Right. And so the standard line that a lot of people say is, look, we learned from the hyperinflations in Europe and from Latin America and even Israel in the 80s that if the central bank gives in and just starts running the printing presses, that's bad policy. And therefore, we've made our central banks operationally independent, and that isolates them from what's happening to fiscal policy. Well, that's fine if the only mechanism by which fiscal policy can affect inflation is the unpleasant arithmetic mechanism. But once you have the recognition that these are nominal liabilities of the government, then that's not the only mechanism anymore, and that's where the fiscal theory comes in.
Well, you mentioned to me that you've just recently returned from a Bank for International Settlements conference, and there's a lot of central bankers are starting to be concerned about fiscal measures. I gave a talk at the European Central Bank at the fiscal division, and I was expecting everyone to just be saying, oh no, this is rubbish. And in fact, they seem to be responsive to that. So what was your impression there? Do you think that they might be trying to, what's the optimal actions that they should be taking now when they see that the governments that they're dealing with are kind of going in a direction that may be problematic?
Well, I think they are quite nervous. They're not nervous just about the short-run issues, but they're starting to get very nervous about these longer-run fiscal issues as well. And I think they are starting to understand this fiscal theory mechanism and how that can make it impossible for them to do their job, which is control inflation. I think the other bind that they're in right now is there was a lot of pessimism about economic growth around the world. And with interest rates, at least in the U.S., at zero, there isn't any more interest rate leverage to use to try to stimulate the economy. And so they're really feeling the pinch that, it's hard to stand up to the fiscal authorities' expansions if at the same time economic growth is so weak. And so I think they're really at a loss about what to do. They recognize that without substantial fiscal reform, they're in a really tight bind.
And also these issues that you're highlighting, the weak recovery, it seems the main concern of some policymakers, especially in the US, is on short-term a danger of deflations, which is the very opposite of what might be coming in the longer-term future. And I actually have a paper that seems to be relating the two, and it shows that the countries that are more likely to see higher inflation in the future might actually be also more likely to see a deflation after a downturn. And the intuition is that the reason is that there's more likely to be a conflict between the government and the central bank, and because you get stuck in the conflict, you have problems both on the downside and on the upside. What do you think a deflation is potentially a possibility in the United States or other countries? And
I think it's less of one than it was, say, 2 to 3 years ago. And if you, one of the interesting things about the literature on looking at these long-run fiscal issues is while the central bank can lose control of inflation, it doesn't lose it in some dramatic way. So we have some simulations where if you look over a 40-year horizon, inflation drifts away from target by only a couple of percentage points. But that's average inflation. And the mean is really masking what's going on. So I'm going to get back to your question about deflation, because what's going on here is the risk associated with inflation becomes very asymmetric. So in these simulations that we've been looking at, the distribution of inflation has very fat tails. So there's a small probability of pretty high inflation, not hyperinflation, but 40, 50% inflation. And so what that's saying is the way to try to look at the data is different than just looking at, say, means. So the standard way that people look at, is there evidence of future inflation in the data as they look at long-term interest rates. But that's really looking at what the expectation of inflation is. It's not looking at the distribution of inflation. If you look at options data, and you back out from the options data what the expected inflation distribution is, what you see is that there was quite a bit of probability mass in the US on deflation. That has now shifted. And while they're still not putting lots of probability on high inflation, it's definitely the case that markets are less worried about deflation now than they used to be, if you look at the options data.
So that's what makes it really difficult to see in the data. But the implication is that the higher, under active fiscal policies, there would be a higher variability in inflation. And obviously then it would mean that potentially we might be more likely to experience the deflation when we're on the downswing.
Well, yeah, except that if you're then building in these demographics where, these promised transfers are growing relentlessly, then that pushes all the risk sort of onto the high inflation side rather than the low inflation side.
So this is also distinguishing it from the monetary arithmetic, in the sense that the arithmetic would really predict a relatively high average level of deflation, whereas the fiscal theory is kind of about the second moment more than about the first moment.
That's exactly right. So you can be in a fiscal theory equilibrium with any average inflation rate. It could be zero, it could be negative. But it would still be that fiscal policy is driving inflation. So it's a fairly subtle problem, subtle kind of equilibrium. And how you look at the data is very different than in, say, an unpleasant arithmetic world.
So now, I mean, some people have used the current actions in terms of lots of quantitative easing we've seen in the United States and Europe, and they would say, well, you see the central bank's printing money, and this is a vindication of both Sargent and Waller's as well as the fiscal theory. So maybe if you can first say, are they really printing money, or is it kind of a little bit more subtle than that? And also what you've just said means that it may or may not be a kind of feature of the fiscal theory.
Right. Well, first of all, central banks always print money. The normal situation is that the central bank's liabilities, which are bank reserves, are very short run, and then they normally keep very short-term assets, short-term government bonds, as on the other side of the balance sheet. What quantitative easing has done, it's had sort of two different components to it. One is they've gone out and bought long-term government bonds. And so they're trying to tilt the yield curve, pushing down long-term interest rates. There's a precedent for this in the U.S. back in the 50s, I think it was, the Operation Twist. So they're printing money to buy those long-term bonds, but they would print money to buy short-term bonds too. So in that sense, it's another red herring. There are lots of red herrings out there. It's another red herring to say, oh gosh, this is terrible stuff. Now, the one point, though, is that now what we're seeing is that the maturity structure of their liabilities and their assets are not matched up right. What does that imply? Well, if you have a lot of long-term assets, those long-term assets are going to be riskier. And so central bank balance sheets have become riskier, which I think is the real key issue here. They also became riskier when they went out and bought a bunch of private assets that were toxic and so forth. So why should we worry about the riskiness of the central bank's balance sheet? Well, because suppose that those assets go bad, then the central bank can run into capital problems. And why does that matter? Well, because now it becomes fiscal policy that has to step in and recapitalize the central bank. So what I think is really becoming clear, and this is true among the central bankers that I've talked to, is they're recognizing that these quantitative easing actions were really fiscal actions. And their effectiveness relies completely on the fiscal backing that in most countries is only implicit rather than explicit.
It's kind of like a speculator that is borrowing short and buying long. I mean, it can lead to problematic outcomes. But it seems that people have been trying to assess how successful the quantitative easing has been, and it seems that the governments have actually gone in the totally opposite direction. I mean, what central banks have tried to do is to tilt the yield curve, as you suggested, and in fact the government could do exactly the same by just issuing more long-term bonds.
Precisely.
And in fact, if you look what they've done. Sorry, more short-term. But what they've done, they actually did the opposite. So they kind of, in a sense, they've been reversing the actions of the central bank rather than helping it to lower the long-term yields. And obviously, the governments have done it to reduce the rollover risk. But again, there seems to be a conflict between the two policies. They're not cooperating in the way that they should. Do you have that sense?
Yeah, but I always have that sense. I mean, we have this view that somehow we can separate monetary and fiscal policy, and we can put them in their distinct institutional boxes, and that life can go on just fine that way. And in normal times, that's true. But we're not in normal times now. We haven't been for the last 3 years. We're not going to be for the next 50 years unless there are dramatic fiscal reforms. And I think we have to recognize that we need to be looking at the whole monetary fiscal framework, perhaps from scratch. And then you bring in all the macroprudential and regulatory issues as well. And you can see that it's a really complicated kind of triad that that we need to be looking at, I think, with fresh eyes.
Okay, I think it's time that I give the opportunity to our studio audience to ask any questions that they might have. Harry?
So you mentioned that you didn't think now was the time for US fiscal consolidation, and I think you're right. So what should the US do in the current situation? For example, should there be an enhanced kind of job creation program? The recovery is very weak. Eventually you have to try to deal with the debt situation, but you've identified the problem. What specifically do you think the US should do currently?
Well, I think that the most sensible policy would be a pretty big increase in infrastructure spending. And I say that in part because we have a lot of underutilized resources. Now is a relatively inexpensive time to be building infrastructure. We desperately need the infrastructure, but we don't want to be doing that in isolation. I think that has to be coupled with serious long-term reform that grapples with those mile-high pictures that we were looking at. And you know, just going out and doing more infrastructure spending not only is not politically viable, but is probably irresponsible if you aren't also dealing with the long-term issues.
And you started talking about the long-term solutions to this, and we've had Don Brash here, the former governor of the Reserve Bank of New Zealand. We were discussing some of the options. So how do we legislate fiscal rules and make sure that fiscal spending doesn't get out of hand? I mean, what are the European Union has tried to do that through the Maastricht criteria, but it hasn't been very successful. So how do you legislate? How do you constrain future governments from spending too much, and how do you make sure that they behave in a responsible manner?
Well, this is the perennial question. I think the best way to answer it is try to point to some success stories. There are countries that have been successful at implementing these reforms, and they've managed to stick to them even during this crisis. So Sweden comes to mind, Chile, I think Australia and New Zealand are also models that we could be looking at. The components are that there is often a surplus target. There may be a debt target that's coupled with that. In Sweden, they have a fiscal policy council, which I think, at least in small countries, that works quite well. The Fiscal Policy Council is independent of the government, and it is given a forum, so it testifies actually before Parliament, and it can raise issues, you know, and try to embarrass the government if it wishes, and then the government has to respond. And so, at least in small countries, these things seem to be working.
So it's more of a stick than the carrot. Can you think about any carrot kind of solutions that would make it more attractive to politicians to constrain the spending? I mean, it doesn't seem to be much going on. You mentioned 4 countries actually, and all of them happen to be inflation targeters. And one of the things that comes out strongly from my research is that, you know, if you fix and institutionalize the change on the monetary front, it may actually somehow affect the behavior of fiscal policy. And let me just show you, this is from one of our research papers. These are the early adopters of inflation targeting: Australia, Canada, New Zealand, Sweden, and UK. And so three of the countries that you mentioned, and this is the GDP ratio, but it's demeaned. So we took the mean out so that you can see the trends nicely. And the shaded area in each case is when inflation targeting, meaning a numerical target for inflation, was legislated. And what you see that with a bit of a maybe two years gap, there was an improvement not only in monetary policy but also in fiscal policy. And Don Brash was basically saying, and he was the governor, so he's had experience with this, he was saying, yes, when we adopted inflation targeting, it had a big influence on both political parties in thinking about, you know, what they can or cannot do, and that's why we see the improvement. Now the next slide is showing the same period for the non-targeters, and what you see, in fact, now we know that the situation has further deteriorated. So what we see is that that the fiscal policy has gone in the opposite direction. Now we've got the next slide is actually we've tried to do some fiscal VARs, which I know you have a problem with, so I'm not going to dwell too much on it. But this is impulse responses, basically showing that in the inflation targeting countries, pre-inflation targeting, which is the green line, a fiscal expansion was accommodated. Whereas in the post-inflation targeting region, this is the blue line, fiscal expansion have actually, the central bank have gone against it. Whereas non-targeters, the next slide, like Switzerland or the US, you actually see the opposite. They seem to be accommodating now, which is consistent with your estimates of fiscal rules or fiscal regimes, whereas in the past they were. So do you think this might be, if direct fiscal reform is not very feasible, maybe we can, if the US adopted inflation targeting, maybe that would put more pressure on the politicians, because they see now that they're dealing with a Fed that is going to be strongly committed to inflation, so there's no way they give in, and there's more chance of promoting regime M as opposed to regime F.
Maybe. I think it's a bit of wishful thinking, but there's also a chicken and egg problem here. So Brash may say that it was monetary policy that kind of forced fiscal reform. If you talk to the governor at the central bank in Sweden, he actually thinks that it was the reverse, that the most important reform was the fiscal reform, and the monetary reform was sort of coincident with it. But this is actually putting, again, you're putting your finger on a really fundamental problem. And this gets a bit technical, but essentially the problem is regime M and regime F are observationally equivalent. And what that means is you can generate the same data from regime M as you can from regime F. Now that poses a challenge for economists to try to find what kinds of economic restrictions can tell you which regime you're in. And nobody's solved that problem yet. And so, well, I've done a lot of VAR work myself, and I recognize that, I think these are very interesting patterns of correlation that are out there, but it's quite difficult to infer what is causal here. And so I guess the last thing I'd say about this is Europe is a great counterexample, because EMU was an experiment where they said, okay, look, we recognize that a monetary union without a fiscal union is a problem, but what the heck? Let's do the monetary union, and that'll force the fiscal authorities to conform. Well, what have we seen? So,
well, I think the explanation is, and it's also something that I'm trying to model in one paper, is this free riding problem. If you have an individual country and the central bank's fighting against the government, then and raises rates, it really punishes the government in a major way. If you're in a small country, a part of the union like Greece, all your fiscal expansion, you're getting all the benefits because you're buying the votes. But the common central bank is not going to punish you because they care about the union as a whole. So there's this free riding moral hazard type of problem, especially with small countries. But I agree with you. I mean, based on, at face value, this would say, well, the ECB should have perfect fiscal outcomes, which is obviously not
well, and also I think in Europe you can even argue that what's happening now is it's a race to the bottom. That the ECB has become the central bank of Greece, and we're sort of relying on Germany to be the fiscal authority for Greece. And it's not clear that is sustainable. And I think if you talk to some German economists, they'll make exactly that argument. And so the political economy, I think, could cut the other way also.
Okay, I think we have time maybe for one last question, if there is one. Okay.
How do you deal with the sort of political constraint that there's this party in the United States called the Republicans?
Is there?
The Republicans in the United States want some kind of fiscal consolidation. Time in the US's recovery is very weak. They don't want to raise any taxes, and they're strong in the United States. Their political position is quite strong. I mean, they also don't believe in dealing with climate change and lots of other things. How do you address this? How do you get people to think rationally about, in this case, an economic issue?
Golly, that's not an economic question. I was hoping you would end with something that sounded more economic, like, how do you model that? I think that it could be that markets will end up informing the Republicans and the Democrats that if they can't get their act together, the U.S. economy is going to really suffer. You know, I mean, a lot of Republicans have very blithely said that, oh, this debt ceiling thing, you know, it's no big deal. Well, we'll see if it's no big deal. If they can't find a resolution to this, we'll see how markets react. Maybe the world really is Ricardian and people believe in their heart of hearts that eventually there will be dramatic entitlements reform, we won't need to raise taxes, and that'll be the resolution. Maybe that's what people believe. So I think the really hard problem here is everything that's going on hinges on what people's expectations of future policies are. But we don't observe those expectations. So I can always tell you a story that's consistent with any equilibrium that we're observing by just varying those expectations, which if they're free parameters, I'm free to do. And so Republicans are varying those expectations in whatever manner is sort of politically expedient. And I think the Democrats are too. So I don't think this is a partisan point. I think neither party has really been terribly responsible here.
Okay, well, I think we don't have one more question.
Do you have anything?
So we might have to finish here, I think. But before we do, we have a little thank you present, Eric. And we've already done that with our previous speaker. We've got some Australian football rules tickets for you and your son on the weekend. So thank you very much for your contribution. Please join me in thanking Eric for his interesting talk.
Thank you.
Thank you. Thank you, Eric.